it goes. So I started my bachelor initially with just getting out of debt, which was the longest and the hardest process to get into. To complete for me. And then, so I started writing these articles on Facebook, and they just picked up. And then all of a sudden, I became this Facebook celebrity with more than 4,000 people every day asking me finance questions. I usually start these sessions by telling people, or I'm not trained in the field of financial advice. There's people who go to school for this thing. So now I'm self-taught, and it's a disclaimer. It means you cannot sue me, because you won't find me in the records of people who are supposed to advise you. But I'm very careful not to tell people exactly what to do. I won't tell you to go buy Bitcoin, or to go buy gold, or to go buy Sasol. I just give very general financial advice. But I just want to put it out there that I'm not a trained financial advisor in any form. I'm self-taught. So yeah, eventually I also created a blog where I can document some of the articles that I was sharing on Facebook, and the blog is on dear.africa.wordpress.com. So what I've noticed, especially now, I think probably in the last 2 or 3 months or so, there's a lot of people on the internet that want to start investing, and it's a good thing. It's not something that I discourage. But I thought he was invited me and said he wants to host a seminar during this lockdown, and he asked me if I can present any topic that I can choose. I thought maybe the best topic for me is just the steps that one needs to take before they can start investing. These steps are not cast in stones, and you can actually start investing without going through these steps. But if you do, you will have problems later on, because Monaro will know that you can't do a construction without building a solid foundation. So these are sort of foundation steps that you need to do to start your investment journey. And if you do them and you do them right, your investment journey would go on for many years without any interruption and without problems. I didn't prepare a presentation, so this is just to give myself notes as I go along. So those are the sort of the 4 steps that I want us to discuss today. And I think we have about 30 minutes to try, so I'll try and be quick. I just want to greet people as they come on. Elgaya Mangwan, you're welcome. You're welcome.
Thank you very much.
Right, thank you. So the first and most important one, guys and ladies, is debt. You can start investing while you have debt. You can, absolutely. As I've said, that this is not cast in stone. But it works counterproductively, because debt is very expensive to manage, especially unsecured lending. Unsecured lending, I'm talking about the credit card, store accounts, Jadia Barrow, and finishers. Those ones are very high. So what you have there is you would have someone who has a credit card where the banks are charging you something in the range of 16 to 22% interest on a credit card. And when we talk about stable investment forecasting, we always look at retaining your return on investment. We always think a fair one is something between 12 and 15% return annually. This is not Bitcoin or any of those things that people promise you out there that will make you rich in one day. These are long-term guaranteed investments that they will roughly give you between 12 and 15%. So when you have a credit card that you are servicing at 21%, and you have an investment that brings in, say, 12%, you can already see that you're working at a loss. So you are servicing this debt at 21, but you are have an investment on the side which is only giving you 12. So you are effectively still paying around 12 minus 21, around is it 7 or 9, 7 or so? No, I mean 9%. So you can see why it is not advisable. Even if your investments are doing good, but you're still servicing debt, your investment, your net is not growing, if we can put it that way, because you're making money on the one side, but you are losing it on the other side. Ideally, you want to be in a position where you are not paying anybody interest. You are the one who is getting interest. So that's why you want to kill your debt first. And with a strong emphasis on the high interest ones, your credit cards, your store accounts. Cars are also very high, and I know it takes a long time to pay off a car. Some up to 7 years, I think now, that it can take you to pay off a car. But if you want to start this journey and you want to seriously do investment, you are better off paying more for your car so that you finish it quickly. So instead of, let's say for instance, your car is 5,000 Rand per month, and then you want to start investing and you say you want to invest, you can only invest 2,000 Rand per month. I would rather pay off that car with 7,000 Rand a month and pay it off quickly. As soon as you pay off the car, now you have 7,000 to invest instead of 2,000 to invest. And this investment is going to give you, it basically pays you double, because now you're no longer paying for a car, which you're paying interest on. But now you're paying only for investments with a higher capital that you are using. Houses are generally acceptable, but I would also advise people to pay off their houses as soon as possible. Houses go for 20 years normally. Some banks will even push you for 30 years just so that you can afford. If you want to do the investment journey, I would say aim for 7 to 10 years. Even 15 years is doable. But houses, you can use them as part of your building your investments, because the house, unlike a car, which is not a great asset, a car depreciates quickly. So that's why you actually want to pay off a car faster, because 2 reasons: it has a high interest and it depreciates quickly. At least the house gains value, so it actually adds to your net as you pay it off, and as the price or the valuation of your house increases, your net increases there. So even if you aim for, say, 10 years to pay off a 20-year bond, you can, in that 10 years, you can pay a little bit extra into your house. There's a lot of calculations that are available. I can give you guys if you want to see how much extra you need to put in a house to reduce the term. You know, you can play with these calculators to see what happens if I add 100 Rand. You'll be shocked to see that 100 Rand can actually shave 3 years of a 10-year term. Then when you add, hi Visa, can you please mute yourself? Thank you. So when you play with these calculators, you can actually see that when you add a certain amount to your bond, how many years you shave off by just paying a little bit extra into your bond. Another nice way of using a bond, which I think I want to wrap up now on the first one, which is debt. I think I've covered most things today. I want you guys to think of questions, because we're going to do questions later at each level, and then we'll just tackle them together at the end. So you can start your investment journey while you are also paying off a bond. So this is not, I wouldn't use the same example I was saying, whereby you want to pay off your car quickly and put everything on the car so that you can finish it quicker, because the house will take that much longer. What you do when you pay extra into most bond facilities is that they allocate that extra money that you pay extra. Say your bond is say 10,000 and you decide to pay an extra 1,000. That 1,000 goes into, with most facilities, it goes into a thing called an access bond. That money saves you interest that the bank charges you on the bond, but it's also available to you anytime you want. So that is a very good place to park your emergency fund. So for people who have bonds and houses that they're still paying for, I would suggest that instead of putting their money, their emergency fund into some other savings account, rather put them in your access bond, because they will work for you there. They will save you the interest that the banks are charging you on your bond, but you have access to that money. So why do you want to have an emergency fund? The main reason why you want to have an emergency fund is so that you don't go back to debt. The reason most of us go into debt is usually, sometimes it's our own made up emergencies, but sometimes it's actually genuine emergencies. Say things that you don't have budget for and they occur, and you don't have money at that point in time, so you just quickly get a credit card to pay off those things as they happen. Most people advise you to have 3 months living expenses. So this is not your 3 month salary, it's your 3 months expenses. And if you keep your expenses low, this is really not that bad. So don't compare your emergency fund ratio to your salary, and then maybe you're getting a nice decent salary, now you are worried that how can you even save 3 months of that. Just look at what you spend on a month-to-month basis, and that is ideally where you should aim for. Emergency fund is also something that you can build over time while you are starting your investment journey. So it's not to say that you can't pass that level until you can now start investing until you have got, say, 3 months or 6 months in your emergency fund. And emergencies don't happen. They don't happen every month. They don't happen. Sometimes you can go 6 months or even a year without a major emergency. So you can even gradually save, depending on your affordability. Say you save 500 towards an an emergency fund, while the rest of the money you allocate to investing. This is just your own little insurance, and we're going to move on to insurance quickly, just to make sure that if you have got some emergency, maybe a sick child, or you're sick and your medical aid is not covering something and they need it now, you just pop into your emergency fund to get that money without going into debt. And then after you use the emergency, obviously you look back at your budget and try to replace that money. Even if you replace it over a few months, it's fine. So for instance, if you use 10,000 from your emergency fund, you can decide how long it will take you to put back the 10,000 by just dividing it by the number of months you want to cover it. I just want to give you guys a little tip that I also use my emergency fund for. Your car insurance, they usually give you very favorable premiums if you ask for them to give you a large excess amount. And I know a lot of people, even myself included, when I started having my car, I wanted, we want the low premium, but we also want the low access, just so that when you are in an accident, they don't say now they want 20,000. But right now, actually, I put my access at 20,000 Rand on my car, and then that drives my premium down, very little premium that I pay on a monthly basis. That is some form of a self-insurance, if you think about it, because what I'm saying is, if my car gets into an accident, I'm willing to pay the first 20,000 Rand of that repair, but I'm not going to struggle to find 20,000 because I have it in my emergency fund. And then you work out how much you are saving on your insurance. Let me just give you a simple example with easy numbers to say, if your insurance is 1,000 Rand, and then you tell them, guys, I want you to put me on a 20,000 Rand access. you calculate, and then they give you a new premium. Say your new premium now is 500. I'm just making very easy numbers here because I'm not very great at math. So now you are saving 500 per month. You calculate how long it will take you to get to 20,000 with the 500 that you're saving. That's how long you are basically going to break even for using a high access. If you get an accident before that period, it's okay because you have an emergency fund that you can use for that. But if you don't, after that period, for me, I think it was about 18 months, I will have broken even. After that period, you have broken even. So it means you have saved enough that you can just use that saving now as your access because you've been saving it over the last 18 months. After that period, now you know that basically your emergency fund has been replaced. What I have found, psychologically for me, this has improved my driving and my alertness, because I know every mistake that I make is going to cost 20,000 rand out of my pocket. I've had a lot of people saying, it's fine, I have insurance, when they drive their cars carelessly or something, but now I don't have that attitude anymore because I have self-insured my car, and I don't want that. I don't want to be in any form of accident. So that actually increases your risk profile. It makes you a better risk for the insurers to insure because you don't have accidents. Ideally, insurance is one of those things that it would be nice if we never have to use them. That is where you want to go. So that's like a little psychological boost of doing this high access thing, because if your access is 1,000 rand, you'll claim every month. You say, no, let me just claim. But if your access is 20,000 rand, you wouldn't play around. You wouldn't let my little brothers know that my car is not for running to the shops as and when they want, because then my risk is at risk there. I want to quickly move on to insurance. And insurance is a broad term here, but it's basically you want to try and insure every thing that could happen around your life that could cause you a financial setback. We've already talked about a car. I know some people they think they can go without a car insurance, and they take that chances. If your car is really cheap, if it's a 1992 Skodonk and you think, you can self-insure it, if it gets stolen, you can buy another one quickly, that's fine. But what happens if you run into 5 million rand car in Sante and you don't have insurance? You are financially ruined, because even a bumper on a Ferrari will take you many years to repay. So if you have an old car that you don't want to insure, I will advise you to get just a third-party insurance, just to make sure that if you have an accident and you damage a third party, a wall, or you bump another car, then the insurance will pay for the damage for the other people, and you will sort yourself out. So that just protects you, that when that happens, now you don't have to go back into debt to manage that problem. You don't have to use your emergency fund to also do that when there's an insurance for it. And this logic applies to all sorts of insurance. Medical aid, it's very important. Even if you are healthy, I always advise people, if they feel they are healthy and they feel like they don't need a medical aid, maybe just go for a hospital plan. Just in case you are in an accident. You see, you are not sick, but you get into an accident that needs you to be hospitalized, and hospital bills can easily go into hundreds and thousands in a few days, and without insurance for that will ruin you financially. So if you are relatively young and healthy, go for the cheapest medical hospital cover you can find, and this applies for you and your family and people that you are financially responsible for. The other forms of insurance is insuring your income. In this environment we find ourselves in, and a lot of people are going to lose jobs now. A lot of people are going to lose incomes And unfortunately, you can't go and apply for this kind of insurance that protects your income now. But as we rebuild after this COVID problem, I think we must think about adding insurance to insure our incomes. This is income protection, retrenchment covers, and all of those things. Some of these things can be very expensive, and you don't have to. You don't want to over-insure yourself. So you need to look at your career and your job prospects and all of those things before you decide that if you really need a cover for income, or if you think you'll be fine. Some people, I work in IT, and it's very easy for us to fortunately get jobs, so I usually don't get this type of covers. And then it's much easier for me to just tide myself over. I've been retrenched once, and I managed to survive about 3 months with my emergency fund, and there was no issue for me, and I quickly found a job. But some people can go for quite a long period, depending on what careers and what sectors they work in, to get a new job. So if you feel your career is relatively safe, so maybe you don't need this type of cover. So just assess your career and your needs there. But you definitely need insurance to cover yourself, so that all of these things that I advise people to do is so that ideally investments is things that you don't want to sell, and especially when it's a forced sale. So when you have an emergency, like you lose your job and now you're out of a job for 6 months, and you have got this nice investment that is maybe worth R1 million, you don't want to go and exit that investment so that you can cover yourself. One of the reasons we don't want to do that is if you look now, the whole economy worldwide, I think it went down by about 30% initially when the market started digesting the impact of the COVID-19. Now it's recovered to around, we're still about down negative 10%. So if you were to need an investment money now, you'd be exiting your investment while some of them would be at a loss. So you just want to protect yourself that you don't ever have to sell your investments to cover things that could have been covered by not having a debt or having an emergency fund or having the right insurance for that. That is basically why I advise people to get insurance, so that your investments can run for as long as you want them to run. If it's 10 years or 20 years, you know, in that 20 years, you are not going to withdraw money from your investments. You are just going to keep on adding and letting them grow until you reach your target or you reach your goal there. The last item on my slide is tax-efficient investing. I'm sure you guys have seen people wanting to buy Sasol, and some people before they say they want to buy, what is that, American Tesla, when it went up 140% in a few days. You know, people usually want to start investing when there's news like that in the market. A few years ago, it was Bitcoin, when it was jumping all over the place, and now fortunately things are quiet. Every once in a while we get forex traders wanting you to get into forex, or binary traders, and all of those things. Tax efficient investing is two things in South Africa. So basically it's the tax-free savings account, which I wouldn't go into much detail now because that's a broad topic on its own, as well as retirement annuities and pensions. Those two things should be, when you invest, you want to make sure that you invest in those two first. The reason is mathematical. It's tax efficient to invest in them, so you need to fill them up first, because it's basically government giving you free money. In the sense of tax-free savings account, government is saying that you can invest 36,000 rand a year or 3,000 a month, and the limit currently is 500,000 total. So that's what you can contribute to a tax-free savings account. That money will never be taxed by government. So if you can, before you go and start investing in anything, your first investment should be, if you have 36,000, you can go and invest in a tax-free savings account, because that money will never be taxed. No tax when you exit, nothing. So that's free money, because every other investment outside of that will be taxed. When you make an investment and it grows, when you realize your investment, government is going to say, give me 18% of that or 20% of that, depending on what type of tax they are getting. But anything in a tax-free savings account, it's free. Whatever money you get in, whatever growth you get in, any dividends will not be taxed. So that is a tax-efficient way of investing. And you can't buy Sasol in a tax-free savings account. So you can't be buying Sasol shares when you don't have a filled-up tax-free savings account of 36,000 Rand a year. When you have done that, maybe you can start thinking about extra investments, because those investments are going to cost tax. And the second one is your pension or your RAs. Government here, again, they allow up to 27.5% of your income to be invested in a pension or in an RA. How this works is, I'm going to use simple maths again. If you earn 10,000 Rand a month, government is taxing you. Let's just assume you earn 10,000 and you don't pay this. You don't pay money into your RA. Government is going to tax you on 10,000. So you're going to be taxed on 10,000. Your income is 10,000. But if you say, okay, I'm going to contribute 2,750 to my RA, which is the max that you can if you earn 10,000. If you contribute 2,750, then government is no longer taxing you on 10,000. It's only taxing you on 6,000 and a few hundreds, you know. So your tax becomes lower there, but this 2,700 is yours because it's now sitting in your pension or in your RA. Those are basically the two tax-efficient methods that you can use to invest. When you have done those those two, now you can, I don't care, from there you can go wild and you can invest in berries or honey or gold or oil, negative oil in America or whatever, because you have basically covered your basis. Duarte, I don't know if you can hear me, but I think this will conclude my presentation on those steps that I advise people to take before they get into the journey of investing. And then I'll also take questions maybe for 5 or 10 minutes.
Thank you, Mama Gogo. Thank you so much, my brother. And thanks for those who joined this seminar. Now we can open up for questioning, and Mama Gogo is here with us. He will respond. We will be closing at 2 o'clock. Those who want to ask questions, feel free to unmute and ask questions. Yes, Mnare?
Mama Gogo,
Yes.
my first one, yeah, on the third party insurance.
Yeah.
Is there a limit to it in terms of amount? Like, if I've got, let's say, 2 cars, can I have 2 different insurances? Maybe per car. Let's say one car I've got the third party insurance and the other one I can have a full comprehensive insurance on it.
Yes,
yeah?
yes.
Then my second question again, it will be on the RA. This RA, can't we use it maybe to save on it? Let's say maybe you remember on your savings account, let's say the emergency insurances or something like that, you can put the bulk of the money into that as part of your savings.
Into your RA.
Yeah, no, you don't have an RA. What you do is
Yeah.
what you should direct it to the RA. You save it for yourself as an individual.
I'm not sure if I understand your question, Mna. Let me quickly answer the first one and then we'll come back to this one. Yes, so if you have 2 cars, you have to have 2 insurances for them, and then one of those cars you can just say you want third party only and you don't want say theft or own damage. Yeah, you can. But the second question I'm not very clear. So you're saying?
I get it. on the you've got I get there is an RA.
Yes.
What you do is you don't have an RA. What you do is the money that must be directed to the RA.
Yeah.
You open up your own personal savings.
Yeah.
About it, and then you maybe if you've got a bookkeeper or whoever can declare that is money directed to the savings.
So pension funds are regulated in South Africa by law. There's a regulation called Regulation 28. So you can't just open your own savings and then call it a retirement saving and then qualify for those terms. It has to be a registered pension fund provider or RA provider that manages that money, and then they will make sure that it's compliant with the Regulation 28. So the only downfall really of an RA is because you can't access it until you are 55. But that is government's way of making sure that people don't become a government burden at a later stage when they could have saved for themselves. So you can't access it until you are 55. But if you open your own, you can blow it. You can save money there, and then when the going gets hard, you blow it, and then now you don't have a pension provided, and the government has to take care of you. So that's why there's that rule on it that you can't access it until you are 55. I see on the comments a few people saying they can't hear me. I don't know if this is still the case.
I'm sure it is the problem is on their side, not from your side.
Okay, because a lot of you can hear me. All right.
Yeah, the problem is on their side.
Does that answer
thank you.
Okay.
Yeah, thank you.
Are you clear, Mnar?
Yeah, no, sure, very clear.
All right.
Colleagues, we are opening up for questions. We are here until 2. Remember, this is a free session. If you're going to ask question privately after this session, Mama Gogo might be giving you an invoice. For now, you are still having a luxury of asking questions for free. When after this, it will be an invoice, and I must put a disclaimer that invoice is not going to come through me. You must direct it. Mama Gogo will give it directly to you.
Can I ask a question? Do you hear me?
Yeah,
yes,
you are.
Okay.
And Jimmy, before you start, can I just also say people are welcome to ask any personal finance related question. It doesn't have to be what we were talking about today. If I don't know the answer, I will reply at a later stage to that question. But I'm sure I will be able to answer most questions, even if they are not related to what we discussed today. You can go ahead, Rajim.
Oh, okay, good. With the oil and crude oil being down at the moment, I know how you spoke a little bit, but not in detail. What do you think around if you've got every other shares like your tax investments, RA, what do you think about the Sasol shares price just to buy them on easy equities?
So I'm not a big fan of individual shares, Rajim.
Yeah.
And I think I wrote a post yesterday giving like a standard answer to everyone who asked me what would they do if they wanted to buy Sasol shares.
Yeah.
But I'll just quickly touch on the post again here. So if you want to speculate, so there's two things you can do with Sasol shares right now. If you want to speculate, it means you are saying that Sasol is going to return to the 400 rand price, and right now you think that price is cheap. And you saw how quickly it fell from that price to say $20, and then it started climbing again. So basically, you are betting that this price is going to go back to say 400 rand as quickly as it fell. That is a very high risk investment. If you do that transaction with little money that you wouldn't lose sleep over, it's fine. You can do it. If Sasol falls again, you're not gonna lose money. And if it goes back to 400 rand, unfortunately, it's not gonna make you millions as well. But if you have, say, maybe 100,000 rand and you put it on that share and it goes to back to 400, that will make you an instant millionaire. But if it loses, it will hurt you a lot. So that's an individual share. What I advise people to do. Oh, okay. Sorry, I want to touch on the second one. The second one is if you want to invest in individual shares, be it Sasol or any other company, and you want to do it for the long term because you believe Sasol is a good company and it's worth. You basically think the price that you pay now is underpriced, basically. And you think 10 years from today, Sasol will be worth, say, 400 or 800 or even 1,000, like how the Capitec share ran over a period of 20 years. Then by all means, I think you can even put a plan to say you want to buy Sasol shares every month, depending on your full financial strategy, every month for a certain time until you reach the level that you want of your Sasol shares, and just let them be there and maybe review once a year, but hold them for a period of, say, 10 years and see how the Sasol shares. That is a proper long-term investing, but not this thing of saying you want to buy Sasol today and then maybe 2 months down the line it will be back to 400. Those are the two options where I could say people can buy Sasol shares. You are speculating, you want to play, or you want to hold it for a long term because you think it's a company that's going to be there 10 years from now and it's going to be worth much more than what it is today. Then sure.
Okay.
I don't know if
Thank you.
that clarifies.
Yeah, no, that clarifies it. Thanks.
All right.
Let's take questions. And like he said, feel free to ask any question except health-related questions. Just ask any question related to investment. Yes, you can ask a question. I don't know who's this one or P20 Light. Please ask a question. Your hand is up. Please ask a question.
Hi. Sorry, I was attempting to unmute. I did finally. My name is Mike. Been following Paul for I think about 2 weeks now. So I thought I should join the session. So I just have one question, more so on the policies, specifically education policy for kids, or perhaps having a savings account for them. So I just want to get an understanding between those two, maybe to say in the long run, which one is the better one, because the education policies, they most of the time come with a lot of terms and conditions.
Okay, Mike, welcome and welcome to my Facebook as well. I see you are a new member. So, the education policies is a big one, because I think the financial institutions play on our emotions here, because they know everyone wants to make sure that they provide for their children's education. So they like using this as a sort of a way of guilt tripping people to get their children into education policies. My advice here, and it's not very popular with the guys, the insurance, because mostly this comes from insurance companies. One of my old statuses, I think I wrote, I said, you must use banks for what banks do, which is banking, and you must use insurance companies for what insurers do, which is insurance, and you must use investment companies for investing. So education policies are not investments, they are insurance. sold as if it's an investment, and they perform very poorly, and they are very expensive in terms of charges. And I think the biggest expense with education policies is the opportunity cost, whereby if you would have invested that money elsewhere, but now you've invested it at some insurance policy where, say, for instance, with an insurance company where they say you pay 300 per month, 250 goes to the saving, and 50 Rand is for whatever form of insurance. It basically means that 50 Rand you are losing because that is not an investment, it's the insurance portion of that education policy. If you want to invest for children, I advise you to invest in your own name. Don't put it on your children's name. Just put it as, you can even open, like I said, if you have your own investment account, open another investment account on your name, and then you can just, underline that investment as this is for my children's education. But it's in your name. It is a normal investment like any other investment. You buy normal shares if you want to buy shares, or ETFs or unit trust in it. There's no need for you to have a child's education policy because it's an insurance. You invest in your own name, your own money that you manage, and 20 years or 10 years, depending on when your children are going to school, you can manage that investment and withdraw a portion from it annually to pay for their university degrees or whatever. Whatever is left over is your own money. You don't have to share it with the insurance. You can also invest money for children into their own tax-free savings account. Those, if you do that, don't use that money for their education, but just hand over the money to them because it's in their name anyway. So if you open a tax-free savings account for your child, you can't use that money because it's not yours. When you withdraw a tax-free savings account money, you have to provide a bank account which is in the holder's name, and your child wouldn't have a bank account, so you can't access that money. So that is a form of long-term investing for children, and ideally you don't want to use that money for their education. You want that money to grow for as long as it can. So when maybe your child turns 18 or 21, you can tell them, oh, look, here's a tax-free account that I opened for you many years ago. It is now yours. Don't use it. Just let it run for another 20 years. And when your child is 40, they'll have a couple of millions that you probably only paid 30,000 Rand now, and they will be set for life. But don't use a tax-free savings account for investing for education. Education, just invest your own money. Use that money when your child goes to university at a later stage, and whatever is left is your money. But do not be tricked by these insurance companies trying to sell you policies for education. I think the only positive side of those insurance policies is if you die when you are still young and you have children and you did not save enough for them, those policies can help, because basically some of them, what they promise is they basically use that same language to say, if you die, your child will be taken care of until they go to university. That is the only sort of advantage that I see, right? But the dying part is another topic on its own, which I don't think we have time to discuss, because that's another thing that insurance like using. Chances of people dying are very slim. I mean, even in this COVID-19 thing that is spreading all over the world, I'm sure you've seen the numbers that people that are dying are people that are already at a certain risk, at a certain age. But generally, people don't just die, and that's why insurance companies are in that business, because they know the dying is not the norm; it's an exception. So that's why they play on that. I'm not personally, I'm not planning to die in the next, say, 20 years, and and that is, I mean, they use actuaries to calculate these things, and they know that's why they do it, and that's why they are in business for it. They know that chances of me dying in the next 20 years are very slim. But in the next 20 years, I can make a substantial investment for my children without handing over my money to an insurance company. And if I die after 20 years, my children will be fine if I made good investment decisions. So just, think about it carefully if you want to be taken by the psychological sales pitch of saying if you die, your children will be taken care of. If you are young and you're healthy, you are going to live until you are 60, maybe even 70, unless you get into an accident, which is, that we can avoid. But yeah, insurance are in the business of making money on our psychology because they've mastered it. But I don't buy it. Okay, 5 minutes. Another question or two more quickly. I'll be quick this time if we have more questions. George, I don't have a question.
No. I'm not having any question. I'm still trying to do the introspection of the things that you were saying. Then I'll come to you at the later stage.
Okay, with an invoice. I'll send you invoice.
Okay, there's Karabo Khalid. Please, Karabo, come in. Karabo?
Hi, sorry. I was having lunch while listening in.
Yes.
No, I'm just been listening, obviously just taking a few things in.
Okay, I thought you raised up your hand for a question.
No, just now I just need to plan my life and plan finances, what needs to be paid first, especially during this time with the low interest rates and stuff, especially like with credit cards and all the debt we have. We've already decided to fix our bond payments so that they shouldn't decrease with the interest rate. So we're like, at least that's one thing. But now we're like, what about the credit cards? That's like the next thing. Let's try. We've already stopped our store accounts. We've closed those last year. Overdrafts, we've closed as well. Now it's just the credit card bill that we're just trying to get a hold of things and not try to purchase anything right now. Let's just,
okay.
That's the plan now.
Thank you. Standiwe, you've got a question? Standiwe Meva? Okay. They raised up their hands, but they're not asking questions.
Hi, I have another question.
Okay.
Sure.
I was just listening to the lady talking about the credit cards and other stuff. So I have been getting banks wanting to offer me their credit cards and with a term of about almost 2 months of no charges if you pay the full amount. For those who have credit cards, how has that been helping you, and also from a cash flow point of view, and especially where you know that you can be able to pay it in full in that number of days where you are not charged?
So credit card, Mike, if you can master how to take advantage of them, they are actually very great. In a few ways, I'll tell you how I use mine. So banking is expensive. I think most banks charge in the range of, well, depending on the option that you take, but some banks charge 100 rand, some banks just 200. If you want a black card, you can pay as much as 500 rand a month to have a normal transactional bank account. So what I've done over the years myself is to find the cheapest bank account. I think the easiest one you could use is Capitec. I personally use, I've been using FNB now. I've downgraded many years ago to like a 5 rand account per month. What those 5 rand account does is, if you use them a lot, they actually start costing you money anyway, because you have the 5 rand monthly fee, but then they charge you for every transaction that you do, because it's not a bundled option. Like if you go for, say, 100 rand a month, you get like 6 Actually, all the banks have the 5 rand accounts because they compete at the lower income sector, and at that point, all the banks have like a 5 rand bank account. That's what I use. And then you open a credit card. I've been using a Virgin one, which is free, Virgin credit card. Credit cards don't charge you any transactions on them for swiping. They only charge you if you withdraw money or if you actually send money from your credit card to your bank account. That they will charge you from day one. So the 55-day thing is that if you put all your spending on a credit card, for the first 55 days of the credit card cycle, they are not going to charge interest on that money. So what I will do is everything that I pay for, I pay with that one credit card because the transaction fees are basically free, right? And then when I get paid, I pay that credit card, whatever I spend. Say if it's 20,000 rand is my monthly spending, I just take 20,000 rand from my 5 rand account and I pay it into the credit card before the 55 days is over. So I don't pay interest on that 20,000, and I don't pay transaction fees because I don't do a lot of transactions on my cheap account. So that is how you can take advantage of that 55-day period. You can use the credit card as much as you want, as long as you know that before 55 days you'll be able to pay and start the cycle again. It's basically a free overdraft if you think about it this way, because you spent that money before you have it, but you paid before they charge you interest on it. So that's the one way of taking advantage of that 55-day period. Okay.
Okay.
Hi, everyone.
Yes.
Sorry, my name is Loretta. Sorry, I've got a bad connection, so just bear with me. I'm not sure if we already touched on the easy equities or because I was having problem with the connection. I wanted to ask how you invest, what we need to look at before investing, such things like those.
Hi, Loretta. So we didn't talk about easy equities today. It was not part of our agenda, but I did say we can ask any questions that people want to be answered. But yours is not a quick question to answer. What I can just quickly tell you is that if you don't have an account with them yet, just open an account, make sure that the account is fee-cut and everything, and maybe deposit money if you want, maybe 100 rand to 500 rand or whatever, and then me and you can talk maybe privately. I can help you to see what you want to invest in, and all of those things. But yeah, I can't give you that answer here now because that can take us the whole day. But just make sure your account is up and running. Yeah.
Okay, no, thank you so much. I think we can continue with the conversation later on privately.
All right.
Okay, colleagues, it's now 3 minutes past 2, and we are closing. Thank you so much, Paul Mamakoko. Thank you so much, my brother. I really appreciate on behalf of all the participants.
Sorry, guys.
Has a question. Maybe don't close it out.
Yeah, just the last question, please.
Okay. Let's do like this. Let's have order in the house. We are extending the discussion with extra 3 minutes.
Okay.
Okay.
So
I'm just going to ask something very brief.
Who's speaking?
It's K. It's Katleo.
Okay, Katleo. Then from there, Mamuketo will ask.
All right. Yeah. Just something very, very brief. Did you guys record this meeting by any chance?
Yes.
Yes.
Where can we access it? From Paul's wall or?
As soon as I have the recording, I'll share it. I'll also put it on my YouTube. But they can also, he's the one who's recording. So.
Okay. All right. Thank you. I would appreciate that.
Okay.
That's all from me. Thanks.
I also have a question. the way you explained a credit card, is it the same thing as an overdraft? Let's say you can use a certain amount for overdrafting and then you pay it back with your interest just to cover or charge more. Is it the same thing?
I don't want to make a mistake here and say it's the same thing. I said it's sort of the concept is similar, but it's not the same thing. Remember, overdraft, they charge you a monthly fee on it. So I don't know how much it's an overdraft fee, but banks charge, say, I don't know, 100 Rand or 50 Rand just for having the facility. Even if you don't use it, they will still charge you that that fee. But a credit card doesn't have, well, not all of them, but mine, which was Vision, it doesn't have a monthly fee on it. So everything that you do on the credit card is basically free as long as you pay it off before the 55 days. And you don't withdraw money, because when you withdraw, then there's withdrawal fees and stuff like that. So if you just use your credit card for swiping, there's basically no fee, and you pay it off in that period of 55 days. But an overdraft, they will charge you, whether you use it or you don't, they will charge you that monthly fee on it.
Okay, so you in conclusion, you'd say a credit card is better than an overdraft?
Definitely. A free credit card. If you can find a free credit card, I recommend the Vision one, because I know the banks, they also charge a credit card fee or bundled fee. It's still cheaper to go with a bundled option though. So if you can get like a check account and a credit account where you pay, say, 200 or 300 Rand per month, as long as you move most of your transactions to the credit and you manage it like that, you pay it off before 55 days, then it's still okay. But if you can find a free credit card, that's the best.
Oh, okay, thank you very much.
Thank you. Mama Koko, let's close. And maybe what we can do is for you to share your social media account so that people can follow you. Then those who wants to ask you personal questions, then they can inbox you. Feel free to give them an invoice. This one was a free session. And I thank you, my brother, for accepting the invite. What I'm going to do in some coming days, I will invite various various experts on various topics to share knowledge with us, because we're at home, we've got more time. Now we must use this time productively and be empowered. So I will be sharing on my Facebook wall some invites on various topics that will be presented by various experts. Thank you so much, Mama Gogo. Thank you so much, participant. Bye.
All right, thanks, because I think most people have me on Facebook, so it's fine. But if you just search my name, you should find me.
Thank you.
Thank you.
Bye.
Yes, guys, bye.
Bye.